The best way to think about a venture capitalist is about a pilot, fighter jet pilot. Why is it that in order for you to let a fighter jet pilot fly a real fighter jet, it takes such a long time? Why? Because if the mistake that the person made, crash the plane, is 50 million US. You cannot make that mistake. That mistake is disastrous. Whatever you are building, if it's truly disruptive, if it's truly innovative, I'm not seeing it, you're not seeing it.
Yeah.
So I cannot pretend that I have all the answers, neither can you pretend that you have all the answers, because neither of us has seen it.
Kee Lock, you often talk about venture capital through 4 stages. First we have to source, then decide which company to invest in, and then support them, and finally realize value through an exit. Could you walk me through each stage briefly?
Sure. I think, first of all, in the venture business, we must always remember there's another part of the business which I don't talk about, is fundraising. You need to raise capital before you can do all these other things. So that part is a separate conversation. Assuming you can raise the capital, the next thing you need to do is find the right company to deploy the capital. So this requires you to network, find the people. That could be friends, that could be for collaborators, or consulting firm, from law firm, from the previous entrepreneur, whatever that is. You must find the deal source. And from these various different things that you identify, then the next thing is to decide which is the correct company to invest in. So that is what we call due diligence process. You need to go through it thoroughly. And this is also the process that you need to be knowledgeable, learn what they're trying to do, and trying to come to some kind of conclusion whether this business makes any sense. Assuming you come to the conclusion this company is worth backing, and assuming you can negotiate and find the right value and the right investment terms, you make the investment, you come to the third stage, which essentially you need to, now that you invest in a company, what could go wrong may go wrong, and then you have to find a way to help the company to navigate this difficult journey. And if an entrepreneur is doing something truly disruptive and innovative, they have not seen it, we have not seen it. So therefore, together we have to find the correct journey towards a better company. Now, of course, the final stage is we are in the business of generating return for our investors. The money that we raise on investor, we need to return as much money as possible to them. So we need to find the right time to exit and sell the company, be it IPO, M&A, or to other methods that ultimately create value for our investors.
Yeah. Okay, let's go through each of these stages one by one. So you talked about building a network with your background, consultants, etc. Where do you think the best founders come from, typically?
I don't think there's necessarily, based on our experience, and there's no necessarily one single path that we can say that this is the best way to get it. Take one example called IGG. This internet gaming company listed in Hong Kong. The founder was a very successful executive in many gaming companies in China. And we found out this deal was through his investor. Happened to be investors who have done some deal with us in the past. And this investor obviously, feel that we could value add and introduced the founder to us. And we, after spending some time looking at this sector, looking at the potential and look at many other potential similar company, and decided this is the correct company. So this end up investing in venture company, executed and become successful. So that's one channel coming from the investor. Second one example will be Horizon Robotics. This came from the founder who's happened to be Tsinghua University, one of the top science university in China. And one of our China partner, Zijing, knows him very well when they're in school or whatever that is. And end up, that company, he learned about it. And that's why our China fund invested and make a lot of money from it. And of course, our growth fund subsequently also supported them. And they got to know the founder, Yu Kai. And Yu Kai, of course, them, much bigger. And growth fund was correctly built a relationship with him. From him, he introduced 2 other companies to the growth fund people. So from this founder, we end up to 2 other companies.
Yeah.
The third example will be, I guess, Grab. Grab came about largely because our China team was sharing the ride-sharing experience in China, TT, Kuaiti, how this market have really became really sizable. the Southeast Asia team that time decided that let's do a proper scanning of the sector in the Southeast Asia, look at practically every potential apps in that market, and quickly identify this company called MyTaxi in Malaysia that potentially could be a target to invest. And so the sourcing is through the hard work of identifying the sector, go through one by one and trying to figure out. So that is the third company. The fourth one actually came from our founder. So this is actually the example LPG Commerce, right? LPG Commerce, Melvin actually happened to be a cousin of Wai Hong, right? Wai Hong is another entrepreneur we supported in Malaysia. And he somehow, know that we were looking at this sector and introduced us to his cousin, is Melvin, and end up we invested in LPG Commerce.
Yeah.
So you can see there's no really one particular channel that's better than the other. It's just you have to broaden your network, trying to find as many people as possible and trying to see as many things as possible.
Yeah. Yeah. So to summarize, it's through trusted investors, trusted founders that we've invested in.
We own research.
Through research or thesis that we built around it, and top universities.
Correct.
Top talent.
Yeah, top university, top talents.
Yeah.
Top incubator. Yeah.
Yeah. So has there been a scenario where we invested in a very unexpected founder, maybe not fitting into any of this, and that has worked out well?
Not really, because I think you are familiar with this. We always try to be thoughtful about assessing founder, making sure that we know what is the founder ability, what is the founder's motivation, what is founder's attitude. So going in, we pretty much have spent enough time with he or she to have a better feel of what their philosophy, what is the principle, what drives them. And of course, we will discover more as we go working with them. But generally, I think at the onset, if we spend enough time, we should have a pretty good understanding of what motivates them and why they do something like this. Yeah.
Yeah. This is our approach now. But when you were starting out as a very young person in the industry, what sort of mistakes did you do in terms of like finding good companies to invest in?
I think the one thing I very quickly realized that this is the business of pattern recognition. So in order to get that skills, actually, there's only way is to learn from other people. So one of the things that, I always tell my younger colleagues, if there's something that the senior guys say or did that not convenient for you to ask in the meeting, there's nothing wrong for you to after the meeting say, hey, why do you say that in that meeting? So that's something I do quite a bit. That time when I started this business, I pay a lot more attention to what people do. Sometimes you can ask a question, but sometimes you can't. Ultimately, it's all about trying to access where's the best possibility, what is the best possible entrepreneur to back, and what is the best possible idea to back. So that part, I think, never really changed. It's more pretty much over time, you get better in it. You learn from your own mistakes and try to improve on it. And then over time, you can be better investors.
Yeah. Yeah. So learn from other experienced folks, plus also the number of reps, right?
Yeah.
How many companies do you think you should talk to before you develop some sort of pattern recognition?
I don't know. I mean, I can't remember how many companies. I think I've met so many and I can't even count. As you know, for us, Vertex, we look at 100 companies, we probably only end up investing one. So it doesn't mean that the 99 companies wasted. 99 companies, we may pick out something and we may decide not to invest in particular company, not because the entrepreneur is bad, just that the market that they're trying to do may not be something that we think is big enough. But if the entrepreneur is of any good, he or she will eventually figure out. And then maybe the next one, you can figure out how to fund it.
Yeah. Okay. We have identified which we think is a decent company. Then how do you then decide whether you want to back this? So what are the key things that we would want to focus on? There's obviously the market opportunity, and then there's also the team element, if you could go through.
Well, the easy part is always, first of all, you have to figure out what is the product and solution or the offering, right? So that part, you make sure that it makes sense, right? And it has to be able to solve a major pinpoints that the market demand is large, right? I remember in a couple of our own bi-quarterly meeting, I always matter. If the market is only $10 million in size, even if 100% of the market is not worth doing. So after figuring out what what is the product and offering. Next thing you must figure out what is addressable market. And the addressable market is a part that is harder. Everybody think that addressable market means it's very large, but sometimes the market could be a lot more smaller than you think. So these two parts are usually the easier part in my opinion. The third thing is usually the hardest is assessing the team and the entrepreneur, the founders. Essentially understanding the person's ability, what motivates the person, and what is the person's attitude towards investor, attitude towards failure. I mean, we joke about it sometimes. When we some company when it come to the hardest possible time, and then some of our younger colleagues will say, we never know this person's attitude is that way, which is kind of surprising for us because we should have make sure we understand that matters, right? Is a person's one of those that when the problem occur, he or she will say, you know what, I'm not going to do it, right? Or the person will say, look, it's important for us to sit down and find a solution and move forward on that. And there's some people who actually also not a good listener. And you also need to understand that person. Generally, good entrepreneur are good listener. They may not always agree with you, but they listen well to what you say. So you need to figure out whether he or she is a good listener. Are they listening to what you're saying? They don't have to agree what you're saying, but they at least must digest what you're saying and try to come with some kind of sensible conclusion. I mean, sometimes we met entrepreneur, he or she already have a conclusion.
Yeah.
And they're waiting that the world is flat. And no matter what you tell them, they believe the world is flat. The world is flat. Like, there's no way you can convince him or her that the world is not flat. So those kind of entrepreneurs, you have to be careful because they already drawn to a conclusion without any other evidence and based on their bias. And those entrepreneurs, you have to be careful because those entrepreneurs tends to be, when things are a bit tougher, they will say, I believe this is the correct answer, even though evidence could be against them, right?
Yeah. Yeah. So in terms of founders, capability is quite easy, right? You kind of look at with the educational background, the work background, and the attitude and the motivation. That's not easy to do, especially given the short period of time we interact with them before we have to make a decision. So, how do you do that?
This takes time. I mean, that's why we don't rush into investment, make a decision. I mean, we all talk about this in 2020, 2022. Yeah. All the Southeast Asia relatively inexperienced fund were able to meet the entrepreneur in the morning 9 o'clock and wire the money 2 p.m., right? We never do that not because we cannot wire money immediately. It's because we need to spend enough time to understand what makes up of this person. Because the journey ahead to build a truly disruptive, innovative company, it takes a lot more effort. And the journey is going to be very challenging in the next 5 to 7 or 10 years. It's almost like a marriage, right? So you cannot just decide just by 5 minutes of conversation. So you need to spend enough time trying to understand why are they really doing this? Are they just putting up a show to show us? So you have to try to test out all these things either through meeting them or through a more social setting, or maybe through other triangulation, right? Speaking to their friends, speaking to their colleagues, or other way, trying to triangulate the information that you're trying to understand more. Ultimately, you're trying to keep an open mind, trying to come to some kind of assessment of the person, whether he or she is somebody that you think you can build this company with them over the next 7 to 10 years.
Yeah. Well, would you trust your judgment, direct judgment more, or versus, we do also background checks, right?
No, I think you need to do multiple checks. You cannot be one dimension, right? You don't want to, assume that your, interaction, let's say even 3 hours is the perfect answer, right? You still have to ask yourself whether or not are you, in that confirmation bias kind of a scenario. So therefore, it's still important to do some triangulation from other sources, be it checking their friends, checking of their colleagues, checking of the other thing. This is something you always need to check. But you must also remember that everybody have their own personal biases. So that's some part you have to also take that into consideration. The worst investor is that he or she already decided to invest or not invest, and then find a reason to justify the conclusion. And this is the worst kind of investor. So that's why, every time we have a meeting discussing portfolio, I'm trying to understand that the why are they doing this? What is the product it is? Because I don't get to meet all these startup companies as much, but when they come to a more critical scaled out stage that we need to put in 10 million more, I generally will try to meet them, try to reassess. He or she can say, are you sure this is a company that we're going to bet another 10 or 20 more million dollar in? So that part I will probably do a bit more and try to contribute some of this factor. And hopefully by then the company is already 2 years into building, the entrepreneurs are a bit more sophisticated. He or she are able to better explain what they're trying to do. And so that part is also important, right?
And personally for you, when you meet such a founder, let's say maybe for a dinner or something, what will be some of the red flags?
It's difficult to generalize, right?
Yeah.
I mean, just give one example. Recently, there was one company in other funds was looking at, and the two co-founders, and one co-founder somehow couldn't travel last minute, and the other co-founder came to meet us, and the other co-founder was joined by Zoom, which is okay. And we waited for the co-founder for 10, 15 minutes, and of course, which is okay. I mean, urgent business is always important, right? After the person called online, of course, naturally we ask, oh, everything okay? You know, are you fine? And it turns out that we found the co-founder was busy because he was busy buying stocks and shares, and because the stock was very volatile. So immediately, after of course we finished the meeting with the other co-founder, and I told the investor colleague, this is a red flag because this is not
Priority.
the main priorities for him. Talking to investors like us is not important enough for him to, whatever wealth he may have been doing on the stock market must be a lot more important than this. So this is obviously not important. So I told him, why are we bothering to spend more time anymore?
Yeah. Okay. You also briefly mentioned about market opportunity. Sometimes our assessment, getting it wrong, may be too small. We could also get it wrong in a way, it could be a lot bigger than we imagine, right? So what is the right way to answer this question? Like, how do we really assess market opportunity? I feel like a lot of investors get this wrong, really wrong.
Well, I think this is a fair question. So I don't think nobody can really say that they know the market fully and completely. Right? I'm sure when the ride-hailing or Uber started, I'm sure they do not know how big the market is, right? And because whether they can truly disrupt the taxi market, I don't think that is something that they fully assume, right?
Yeah, so I think there is a famous interview of Bill Gurley saying, talking about a retail investor and assessing the taxi market as like a small number. But Bill Gurley, being an investor in Uber, he knew that, because Uber made it so easy, the market was really expanding.
Yep. It's really convenient. I mean, if you remember Singapore about maybe 8 years ago, by then was the only taxi available in Singapore. It was applied to Malaysia, Indonesia, everything else. The only way you hail a cab is to stand on the street, rain or shine, and try to put a hand out trying to stop a cab, right? And in Singapore case, it's even worse. Sometimes, 4 p.m. is where they change the shift. So no matter what, you will see empty taxi coming by and everything. It's a terrible, terrible experience, right? So it's not a reliable replacement traffic, right? And bus, of course, is always more reliable generally, but not always. And then sometimes they're also subject to certain failure and so on and so forth. But what the ride-hailing like Grab have proven is that once you make it convenient to consumer, they will treat it as a much easier way to transport themselves to one way or another. And that, of course, expanded the market a lot bigger. And I'm sure the addressable market is a lot bigger than whoever may have calculated this, right? In a way, you're right, not to say that a lot of times investors, not just investors, even consultants, they got the market size wrong. And I'm sure everybody remember this story 40 years ago when mobile phone first came out. Motorola had this big, chunky phone, and they hired some famous consulting firm to I think it cost them a couple of $1 million US then. And I remember the market assessment of that form factor of the Motorola phone, the market size 990,000. What did they not factor in was the technology market will accelerate, component will get smaller, phone will become even more powerful, and that expanded the addressable market. So that part they did not figure out, right?
Yeah.
So of course nowadays we all learn this part of a mistake that this consulting firm may make. So when we do this, we always will bear in mind technology is not static. Technology will improve. Maybe we are better in it, but may not necessarily be as good.
Yeah. We talked about both the founding team and the market opportunity. Personally, what is more important to you?
I think market has to be there.
Yeah.
There's no market for the product or this business. There's nothing to talk about. So market is important. To me, that's a given. There's no need to discuss. If there's no market, there's no need to spend time on. But measure over a long period of time. In my assessment, if you have a good entrepreneur, he or she will always figure out all the adjustment they need to do. Let's say software as a service company. We always say that it's important to get to the $1 million, ARR, and that is not an easy task generally. But it's also equally important to get to 10 million ARR, right? That is the important milestone. But then the next important milestone is 100 million. From the 10 million to 100 million, the friction is a lot higher because although the addressable market looks the same, but the product may need certain adjustments, modification. Your go-to-market strategy may have to be modified to improve and so on and so forth. So a lot of times, software as a service company, in most cases, of course, there's some of them are unique. From the 10 million to 100 million takes a lot longer.
Yeah.
And then a good entrepreneur, they will figure out how to adjust to this strategy. I was giving an example of PetSnap. Jeffrey recently, a few years ago, after he crossed 100 million, he actually was quite open and he said, Kee Lock, if you had told me many years ago that it will take me a lot more time and effort to get to 100 million after I crossed 10 million, I would have thought that you did not respect me. But he said, no, today I think about it, this is actually a lot more harder to cross 100 million. Now, after you cross 100 million, the acceleration become much faster. So there's this part about addressable market, the product market fit, and then minimum viable product. These things, they all interplay. While the good entrepreneur, no matter what he or she, they always figure this one out, and then will make the necessary adjustment to get to that point.
Yeah.
So that's why I think, although always say people market is important, market is given. If there's no market, no need to worry about it anymore. If the good market, good entrepreneur has to figure out how to get to the market, how to build a product that address as big as possible on the market.
Yeah. Yeah. So this is the third thing, right? Like once you make an investment, like we just talked about with the example of PetSnap, it's really, really hard. There are multiple challenges, ups and downs. So as an investor, what are the areas you think that investors can really add value? You just mentioned that you did advise him that 10 to 100 is going to be really hard, probably based on all the other experience that you had previously. So yeah.
No, I think first of all, we must always remember, in the very important sense of, let's say, basketball, we are not the player. We are the coach. And the coach needs to always available to help the players to become a better player. Now, there are times that we need to do certain things. For example, if for our business, we will probably need to help them to find collaborators to improve his product. We may sometimes need to help them to find a better, COO or CFO or whatever. Those are the things that we always naturally need to do. And at times we also need to help them to open doors, to find first initial customers, and to persuade people to try out the product. Those are things that, as a good investor, you always have to help. But then also there are other things that we found that a lot of certain startups that require a lot of regulatory approval. And this is something that a lot of times when you're a startup, they are not geared for that. So take Neom and Grab as two near to home examples. When Prajit wanted to start this business, which was in the financial payment space, clearly this in many countries this is a heavily regulated sector. And about 10 years ago, nobody have heard of this business whereby you can use mobile phone to do all this fancy activity and transaction. And obviously, regulator needs to regulate this because this is tantamount to banking. but there's no such rules available then, right? Same thing about Grab. Grab was in the market whereby it was providing taxi ride offering. And that sector was a taxi market whereby there's a regulation to regulate that market. But there's no regulation on people offering apps for somebody to book somebody else's car. That doesn't mean that this is bad. Now, fortunately in Southeast Asia, especially in Singapore, I think the regulators and in most of the time, not always, most of the time, they are quite open and more enlightened to technology. They know technology is important. Technology is a way that they can actually level up. They can improve their productivity. So they are always keep an open mind to consider it. I mean, I think I was telling you the example when we brought Grab to see the LTA, and that time was, I think, CEO was Chua. And he listened to Anthony's presentation about what he's doing in Malaysia, what he's thinking of doing in Singapore. At the end of it, he was very honest. He said, what you're doing is interesting. The problem is we don't have a regulation to regulate you. But does it mean that you are bad? He said, no. But he essentially said, of course, I'm paraphrasing him. I'm sure he said in a much nicer way than I do. He said it's important for him to figure out a regulation to regulate you as soon as possible. Which turns out, I think it took him about 15 months to eventually come out, which I thought was quite a well thought through regulation to regulate that mobile app, ride-hailing app company like Grab. Initial period, and then but at the same time, he's not close to the idea. Said no, in the meantime, you had to wait. He basically just said that in the meantime, there's a taxi regulation there. Please comply as close as possible to what it is today. Yeah. Meaning there's certain things you cannot do. So those are things that in the initial period when Grab was offering, they tried to comply as close as possible to what the taxi regulation then was. And eventually, of course, they came up with a whole set of very comprehensive set of things to regulate people like Grab or the other companies, and that turns out to be better.
Yeah, this is supporting the founders, but investors could also give bad advice, wrong advice. So what are the mistakes that investors typically make when trying to support founders?
I always tell founders 3 rules they must always remember. First rule, they must remember, whatever you are building, if it's truly disruptive, if it's truly innovative, I'm not seeing it, you're not seeing it.
Yeah.
So I cannot pretend I have all the answers, neither can you pretend that you have all the answers, because neither of us has seen it. So therefore, I'm guessing as much as you are guessing. I'm giving the best possible advice I can give it to you. Second rule is that I'm giving you advice and input based on what I've seen in the past or something maybe similar. But because I've seen more than you, founders should recognize that I've seen more. Therefore, my advice should be listen to it carefully. And the third rule, which is the most important rule of all, which is that you are the founder. You are the one who making this company works, and you are the one who executing the company. He or she have to make the right choice. Some part of my comments or input advice could be right, some part could be wrong. And it's important for the founders, he or she, to figure out which part is the correct one, which is part that they should execute on. And ultimately, they need to internalize some of this input and advice and figure out what is the best possible option. And that's why a good founder will take in all the advice, however advice they may not agree, they'll remember it. They're trying to stay on it. They realize that they could be wrong too. They are only human. They will make the adjustment and get to the point of what they need to get to.
Yeah. Yeah, this is a very logical, great framework. And it also proves your point. Like somebody who's very stubborn may be a red flag, because then...
Yeah, no. I mean, sometimes we have to be careful. Now, we cannot equate people who have strong opinion being stubborn.
Yeah.
So that's how I always reminded our colleague, we need to listen to what they're saying. So sometimes entrepreneurs are very passionate about what they're doing. He or she could be right. We may not agree. And we may not, because we don't operate this on a daily basis. We only come on the monthly or quarterly or bi-monthly basis. So we are seeing data point in the discrete manner. So sometimes it's very hard for us to relate to some of the issues that they are doing. So it's important for us to pull ourselves back and ask ourselves, did we miss something? Is he or she saying certain thing that we need to pay a bit more attention to? So sometimes we also remind our colleague, let's not try to jump the gun to assume he or she is wrong. We have to try to understand where they're coming from. And ultimately, after we understand it, we have to point out to them what we think is a pitfall of their thought process and try to be as helpful as possible to get them to see their logic could be wrong. And then ultimately, we all want the same thing. We want the company to improve. We want the company to get to a greater place. We want this company to be a multi-billion-dollar business. We all have the same goal. Just that the path could be different.
Yeah.
And we just have to make sure that we understand where he or she is trying to go to.
As an investor or a founder, then the bigger mistake is then if you're a founder who wants something to happen, but then is not willing to change even when the data is proven wrong.
Those are real problems. The data are showing clearly that the product market fit is not there. The minimum viable product MVP is not even addressing the pain point.
Yeah.
If the founder still can't see that and still insists on going that path, then you have backed the wrong guy. He's not going to make it. But sometimes, to be fair, sometimes we could be wrong too. Sometimes there are certain things that the founders, remember I said they are operating on the daily basis. So they are in the world, they are in the analog world. We are seeing them in a discrete manner. We are seeing them on the monthly basis. So sometimes data to us is not necessarily correct too, because we are also in looking at it discrete data, right?
Yeah.
So generally, the founders that we work well with together, they will sit down, discuss with us, a bit more earlier. They will learn how to share information with us. We also sometimes occasionally refer some of the founders to other founders, because we also discover one thing is that not all founders want to talk to investors because they don't want to appear that they are stupid. And although we can assure them that you don't have to be worried about that, we also know that certain founder wants to really feel free to ask questions. So we also have this system that we always do, that introduce all our founders to each other. So make sure that if they have questions, they can ask the other guy, call him up or call up, say, look, we're having this problem. Have you seen this kind of problem before? So that's something that we also think is quite helpful, making sure that founders can call each other up to help each other. That's also equally important for us.
Yeah. So in the last couple of years, there has been a lot of macro shifts. There is trade war. Then there is also like a reset. Cost of capital has gone up. So what are some of the things you think founders need to adapt to the changing reality?
Well, for sure, is that capital efficiency has become an important point. Gone are the days whereby it's easy to raise money. So investors in this kind of environment expect founder to be a lot more capital efficient. So therefore, founders need to get to product market fit a lot earlier, and then need to make the adjustment a lot quicker. And it's not very different for any good startup, right? You need to start small and then test it out. And if you fail, you need to make adjustment. And ultimately, it's trying to get to the bigger market and then trying to address a much bigger addressable market.
So as investors, we need to realize value at some point. How do you personally decide when to exit?
Well, first of all, any good founders naturally knows that we are in the business of managing other people's money. So therefore, we will need to return capital. So therefore, most good founders will understand the point that at some point in time, we will need to generate returns for our investors, be it IPO, or be it M&A, sell the company to somebody else, or be it that we may have to sell secondary to other investors who have maybe longer fund life cycle. And our business is about 10-year fund life. So we need to invest in company, create value within the 10-year fund life, and then create the return to our investor so that we can justify to continue to do this part of the world. So that conversation generally for us is not difficult because most founders understand that it's nothing personal. It's not that we are trying to abandon them or anything else. Yeah, this is our business, right? So when a company is listed, sometimes we may have to sell this first day because we think that the fund life is ending. We had no other time to wait. Sometimes, company could be listed and then we have 3 more year fund life. We think that this company have more opportunity to grow for another 3x or 4x time after IPO. We may choose to wait for that 3 to 4x more. But that is all based on, assessment. By then, we should know the business fairly well. And then if the company is listed, will be public domain by then. We will be able to access it based on public domain information. But the difficult conversation usually is a company whereby the product market fit is not exactly there. The company may have able to show that they have some market is probably its important market, but it become a feature out of a bigger product. And on its own, to get to that bigger product, probably take another $300 or $400 million more. And probably it's difficult to raise that kind of capital. And maybe it's better off the company to be part of a bigger company, which become a feature of that complete product set.
Yeah.
So that kind of a conversation usually a bit more harder. You have to get the founder to recognize that what you have built is important, but at the same time, it's a much smaller addressable market of a bigger market. In order to get to the bigger market, you may need to do a lot more. That a lot more is a capital that you don't have. And that conversation usually is a bit harder. But founders who are pragmatic, they have raised money, they know, they have communicated to investors, they also know what is the reality. They will understand where they are going, and then they may not necessarily agree everything, but they could see some part of the, some of the reasons of why we want to do certain things.
Yeah. So there's a harder conversation, right? Where the company is not doing well.
No, the company not doing well, that's quite fairly straightforward.
Okay.
And the product market fit is not there. And the data is all there, right? Despite all the efforts. So the market is a lot harder. Not because just the friction to get to that market is a lot harder. And especially, certain established business, B2B especially, certain practices is a lot harder to disrupt because there's a lot more consideration that we may not be aware of. So to convince them to embrace this new technology, may take a lot more effort. And then you may get there, but then to get there, you need the capital to get there. So can you get there with the capital you have? And if you cannot get there with the capital you have, then you have to recognize it.
So earlier you mentioned that we need to generate returns to make sure that we stay in business. So what does it take? And you've been doing this across multiple cycles, right? Multiple 10-year cycles. What does it take to remain in business?
Firstly, you must be able to raise money.
Yeah.
Then you must be able to invest well and then, help the company and then eventually create the returns. I think this is a whole, cycle which are all, related to each other.
Yeah.
And so you have to firstly do well and then same thing. Same thing with our investors. Occasionally, we may make some mistakes. And we have to be honest about it to the investors that, look, we make a really stupid mistake in this one. But fortunately for us, most cases in early stage or even in our early growth stage, when we go into the investor, we actually do it over time. We don't try to put in $50 million into one deal. And we also know that this is a business that our knowledge that need to build, need to address and take time to do that. It's not about spray and pray, not spray as many as possible. It's about building company, working with the entrepreneur, spending time with this thing. So in a sense, it's all about, trying to find the right company to back. And I think I mentioned this to you guys many times. It's important for us to find the right company, right entrepreneur to back. It's equally important for us not to back the wrong entrepreneur, the wrong idea. So those are equally important. Because the second one, you back the wrong entrepreneur, back the wrong idea, you're going to kill you because the money is going to be gone, right? But if you do the first one well, you have good return. Then you try to do as little mistake as possible on that second portion.
Yeah. So, but you mentioned about spray and pray. A lot of people talk about power law, always like a small number of your investment generating outsized returns. Is there a belief in venture capital today you think is wrong?
No, I think this is a business which most people do not understand. And because superficially it looks Very easy. And which is why a lot of people will end up with this thing that you invest take enough bets, and hopefully you hit one, right? This is where the spray and pray comes in, where you spray as many as possible. I think this is one part of the business cycle whereby when everybody now finally understood that this kind of spray and pray never works. So that's why this market now is in a more normalized manner, whereby investors are much more thoughtful in what they're trying to do, understand the business, understand the entrepreneur, understand what is the product market fit, and trying to understand all these things before they dive into back the idea. So that should be the way, right?
Yeah. Okay. So looking back, how has your approach to investing changed over the years?
I don't think we changed very much. It's still by ultimately figure out what is a product, what is a business, what is the market, is the market big enough? Why are these guys doing it? Yeah. Can this bunch of guys really do it? And what is their attitude on failure? What do they really believe in? How do they believe in working with people like us? One time there was an entrepreneur who came to us telling us about what they want to do. And then of course all of us trying to figure out this sector, right? And frankly, we were asking a lot of, frankly, very dumb questions. And we're all trying to get to the same point, trying to understand the product, trying to understand the market, which all trying to figure out. And because it was the first time we were exposed to that idea, which none of us have frankly spent enough time doing our own background research. And we were just listening to it. And the guy was very patiently explaining, no, you misunderstood the point, thing, right? And then, and if I put myself in his shoe, it's frankly very frustrating. You're teaching a bunch of idiots and who has the money to believe in what they're trying to do, and they really don't understand.
Yeah.
So, and
why do you want to do this?
And then that's why I was telling you that I jokingly asked the guy, say, why do you want to do this? We are a bunch of idiots, frankly. It's very frustrating to talk to people like this.
Yeah. If you were to advise a young person in his 20s who wants to build a career in venture capital, what would your advice be?
I would tell he or she probably need to first spend enough time to network with the people in this sector, and then understand what it takes to be in this business, and then make a full assessment of himself or herself to understand whether or not this is something that you want to do. When I was a young venture capitalist, there was a conference I attended. And then there was this founder of Sequoia, Don Valentine.
Yeah.
He's one of the best venture capitalists. And some I guess arrogant reporters, asked him a question. I frankly was not very friendly, and I asked him, say, your business is frankly very easy. Any people with a bit of good education, a bit of ability will be able to take over a business. And I remember he answered it very, very well. And he actually said the best way to think about a venture capitalist is about a pilot, fighter jet pilot. Why is it that in order for you to let a fighter jet pilot fly a real fighter jet, it takes such a long time? First, you go to ground simulator. Get them used to simulator. After they're good in simulator, why do you need to then get a co-pilot, which is the trainer, to fly with him or her for a period of time? Why is it that then, even if they can fly alone, you will then get them to do certain maneuvering that required or not required? Why? Because if the mistake that the person made, crash the plane, is 50 million US. You cannot make that mistake. That mistake is disastrous, right?
Yeah.
Same thing applies to us, right? We raise money, $200, $300, $400 million. We may invest in the company $5, $10 million in the business. It's $10 million. If the company fails, it's $10 million. It's a lot of money. So therefore, in order for us to get to the point to make sure that a person can fly the plane, to make a decision on the $10 million or $50 million, he or she had to go through enough cycle, enough tests, enough experience, enough heartache to prove that they can make a fairly sensible judgment. Now, they may still make mistake once in a while, but the mistake will not be fatal. will not crash the whole plane and kill everybody, right? And that's why, I think our business in a way is very similar. So it's very difficult to say, this is a business whereby it's fairly easy and then somebody can drop in because the fact that he's from Stanford, I'm from Stanford, and now I can do anything. No way. It's all about experience, finding the right company, helping the company, finding the right opportunity, helping the company, building company, and making the right adjustment at the right time.
Yeah. I've not heard this story before. It's a very good way to answer that question on how to be a VC. So one final thing. So what excites you most about the current generation of entrepreneurs?
I think every generation of entrepreneurs are all the same. The good one, they believe that they are on a mission to do something very important. Money is important, but the money is not necessarily the only motivation. I give you an example of Horizon Robotics, the founder, Yi Kai. Now the company listed, and a few other companies he's building is equally, huge. Maybe he's worth about, I never really figure out how much he's worth. Maybe he's worth $7 billion US. Every time we have dinner together once in a while, he's still talking about new idea, things that he's trying to do, everything. Not that he's distracted. He's always constantly trying to figure out, is there something that he can do differently, something he can do? He's not thinking about whether or not he's going to make more money. And then he's thinking about this thing. He's still very, very passionate about trying to find something new, something creative, something that excites him, right? Somebody can feel the energy. Of course, they all have struggles, they all have problems, but they all will sometimes pull through and then get through it. And then get to the ultimate view of building a great company.
Yeah, amazing. This was great. Thank you so much for taking the time to do this.